Hello everyone, it is June 5th, 2025, and we need to talk about your money and the markets. Right now, the Sensex, that big indicator of our stock market, is showing some interesting moves. It has seen some ups and downs lately, which tells us investors are thinking carefully. Is it a time to be bold, or a time to be cautious? I say, it is a time to be smart. The numbers are painting a picture of a market that is trying to find its direction, so we must pay very close attention and not make any rash decisions. Understanding the current mood is your first step to financial security in these markets. Now let's look at the Nifty 50. This index tracks the 50 largest companies, so it gives us a broad view. As of today, the Nifty is also reflecting a cautious sentiment, much like the Sensex. We are seeing some hesitation. This means the big players, the large companies, are also experiencing this thoughtful period. When Nifty moves, it tells you about the overall health of our biggest businesses. If it is struggling to go higher, it means there are questions in the air. Your job is to understand these questions before you put your money on the line. Always watch the Nifty, it's a key indicator. What about Bank Nifty? This index tracks our banking stocks. Banks are so important for our economy's health. Today, Bank Nifty is showing some volatility. This means prices are moving up and down a bit more than usual. This could be due to whispers about interest rates or new banking rules. When banks are strong, it's a good sign. But when Bank Nifty is jumpy, you need to be extra careful if you are invested in bank shares. It is a sign to dig deeper and understand what is causing the nerves in this very important sector. Finally, let's consider FINIFTY. This index is broader than just banks. It includes other financial services like insurance companies and non-banking financial companies. Right now, FINIFTY is also in a period of assessment. It seems to be mirroring the cautious tone we see elsewhere. Perhaps new regulations are on the horizon, or maybe economic forecasts are making investors pause. This index gives you a fuller picture of the financial backbone of our country. Knowing how FINIFTY is behaving helps you make more informed choices, especially if you like investing in the financial services space. Alright, let's talk about two words you absolutely must understand: support and resistance. Think of a support level as a floor for stock prices. It's a price point where a stock or an index often stops falling. Why? Because at this level, buyers tend to think, this is a good deal. They start buying, and that buying interest can push the price back up. So, support is like a safety net. It's not a guarantee, please understand that, but it is a very strong indication. Knowing where these support levels are can help you feel more confident in your decisions. Now let's talk about resistance. If support is the floor, resistance is the ceiling. It's a price point where a stock or an index often stops rising. At this level, sellers might think this is a good time to take my profits. They start selling, and that selling pressure can push the price back down. The price resists going higher. It is a barrier. Understanding resistance is crucial because it can help you avoid buying when a stock is already too expensive and might be about to fall. You do not want to get caught at the top. Why are these support and resistance levels so important for you? Because they help you make smarter trading decisions. You are not just gambling, you are using information from the market itself. Support levels can signal potential buying opportunities. Resistance levels can signal potential selling opportunities. But, and this is a big but, you must always look for other confirming signs. Don't just rely on one thing. Using these levels is about managing your risk and making calculated moves with your money. This is how you trade with your head, not over it. So, how do you find these important levels? You need to look at price charts, look at the history of a stock or an index. Where has the price repeatedly stopped falling and bounced up? That is a potential support zone. Where has it repeatedly stopped rising and turned down? That is a potential resistance zone. The more times a level has been tested and held, the more significant it becomes. But I must tell you, these levels can break. If a support level breaks, the price can fall further. If resistance breaks, it can go higher. So always have a plan. If you are holding long positions, it means you bought stocks believing their prices will go up. That is wonderful if the market is moving in your favor. If the overall trend is upwards and your stocks are near strong support levels, you might be feeling good, but I want you to be smart about this. Always protect your profits. Use a stop-loss order. This is an order you place to sell your stock if it drops to a certain price. This helps you limit your losses. Don't let greed make you hold on too long and lose what you have gained. Now for those of you holding short positions, this means you have sold stocks hoping to buy them back cheaper, profiting from a price fall. This is a riskier strategy, so listen up. If the market is trending downwards and prices are near a strong resistance level, your strategy might be working. However, markets can turn very quickly. You must use a stop-loss order for short positions too. This would be an order to buy back the stock if the price rises above a certain point, limiting your loss. Never ever trade more money than you can truly afford to lose, especially when shorting. What if you are thinking about opening a new long position today? First, take a deep breath. Do not rush. Look for confirmation. Is the stock or index bouncing off a known support level? Are there other positive indicators like good volume or positive news? You must have an entry strategy, and just as important, you must have an exit strategy before you even buy. This means you decide at what price you will take your profits, and at what price you will cut your losses if things go wrong. This is called discipline. And if you are considering a new short position, again, extreme caution is advised. Look for strong signs that the price is failing at a resistance level. Are there other negative indicators? Short selling is generally for more experienced traders who understand the significant risks. Remember, a stock can only fall to zero, but it can theoretically rise indefinitely. This means your potential loss on a short position can be unlimited if you are not careful. Your risk management must be absolutely top-notch. Please be very, very careful here. So, what can make these market trends change? Let's start with news from right here in India. The Reserve Bank of India's decisions on interest rates are huge. If they raise rates, borrowing becomes expensive and markets can cool down. If they lower rates, it can boost the market. Inflation numbers also matter a lot. High inflation worries everyone and can pull markets down. Also, keep an eye on government announcements like the budget or new economic policies. These can create big waves, so you need to be aware of what is happening in our own backyard. Then, there are global events. We are connected to the world, make no mistake. What happens in major markets like the United States often impacts us here in India. If the US markets have a bad day, it can set a negative tone for our market opening. Big international news such as geopolitical tensions or major economic shifts in other large economies can also create uncertainty and affect investor sentiment. And do not forget crude oil prices. India imports a lot of oil, so when oil prices go up it can hurt our economy and the stock market. Company-specific news is another big trigger, especially if you own individual stocks. When a company announces its quarterly earnings, its profits or losses, its stock price can react very strongly. A good earnings report can send a stock soaring, while a bad one can cause it to plummet. Other news like a big new contract, a merger with another company, or even a change in top leadership like the CEO, can also have a significant impact. So, if you are investing in specific companies, you must follow the news related to them very closely. So how do you stay on top of all this and make smart decisions? You must make a commitment to your financial education, read reliable financial news sources, follow knowledgeable experts, not just tips from friends or social media. Try to understand the basic principles of how the economy works and how it affects the markets. The market is dynamic, it is always changing. Therefore, your learning must be continuous. Make informed decisions, not emotional ones. Do not gamble with your future. You want to be approved for your financial life, and that takes knowledge and discipline.